Hello everyone, welcome to Fearfully Greedy. In today's video, just a bit of an update on the month, the ideas I have seen, a bit on the research of the portfolio, and that's pretty much it. In the last month, I'm still sitting on these 13,000 euros of cash, which I have not found a good use for, so I'm still looking very actively because I would like to be more invested at the moment, but it's only 9% or maybe 10% of the portfolio. 9% of the portfolio at this point. The portfolio has fallen quite a bit, so 145,000 euros. Keep in mind there's 1,400 euros here of positions that I have been trying with the Giro to get rid of, so I don't know how hard is that, but it's okay if they can sit there. And then Carvana said has been falling a lot in the last month, quite a few short pieces, which tend to be an annual recurrence at this point. And then they grew by 43% revenues and cars, and they had a very, very, very good year that probably a year ago we couldn't even sign off. But the stock fell quite sharp, and it's been downhill for a few weeks. I would say that actually at 260, I liked Carvana, so I was almost about to buy more, but it never got to that level and it crept up back. But if it keeps falling there, I like it. I think the mousetrap that Carvana has at the moment on this huge market, and that is very resilient and future-proof in a lot of ways. I don't see anything like that in any stocks I see. Okay, so I like Carvana a lot. Okay, then you can see the portfolio here more clearly, close to 10% of cash, like you can see here. Thinking wise, I can be more transparent with you. Like, I'm not hiding anything, but I can tell my mind maybe a bit more. But at the moment, thinking about the portfolio, I'm thinking, and I don't think my videos that's just a few friends see and yeah, few non-friends, we can be friends also, but I don't think I'm moving the market. That's what I mean. But I'm actually thinking of getting rid of these two positions at the moment. Pax, it's just not been what I thought again. I know it's so cheap at the moment, but I also prefer to be in a long-term position, and I thought Pax was that, but I don't think Pax is that anymore. I just think it's cheap at the moment. Very good, like probably top dog in that market for Pax, but not much else. Like I don't think the economics there and the future also, like long term. I think we're using credit cards for a long time, and they will keep selling terminals for a long time. But in 50 years, who knows, right? And yeah, I've been holding for so many years at this point, which I prefer to be in a position that I can be more behind in. And Baba, it's just that it's a great company, future-proof, top player in their markets, everything that probably cheap still, but probably not as cheap as when we bought on the first time. Okay, so maybe these two positions could be invested. If I find something good with the cash, that could be a good, nice position, like 24,000 euros that we could put somewhere. So that's my thinking behind portfolio. Let me show you the research. I'm thinking of sharing this with you also, but you can see here, okay? I have changed this a bit, so let me explain a bit more, okay? But in the last month, I've taken a look at 95 companies, okay? And if you see, we have the date, ticker, logo. I think it looks nice. It looks pretty. Sector kind of business, or like one phrase that sums it up. And then on the next column, I changed it from, so yes, it means it's investable. That's it. Like, I could own this in some way. Doesn't mean it's great, but I can see myself holding this stock. Then don't like, it's just that I don't like the business. Maybe business line, I don't like the setup, I don't like the margins, I don't like anything. Too hard is that I think I prefer to invest in simpler ideas that I can understand easier. So if you tell me like companies that I have invested in the past, but Intel I have like really little idea behind it. Intel is huge, so maybe it's easier to see like on a zoomed out thing, but very like biotech, for example, it's too hard. I have no idea, and I think it's more like a gamble than anything else. And too risky is more like too high of debt, super concentrated on some clients or geography, or just I think it might be a good company, but it's a bit risky owning it, right? And then on the next, I put this mode column, right? Which is, let's do here. Well, you can see like they might have a pricing power, switching costs, brand mode, network mode, scale, intellectual property, and then IPA is irreplaceable physical assets like a mine, like for example for Warrior. And then here I do from 1 to 5. I think how strong that mode is, which I think I don't know, it's easier to see like very strong companies here that I like a lot. Like for example, Apple, I think it has a very strong moat, like so 5. And then trajectory is more revenues, but it can be profits also, like what's the direction a bit of this company. And I put these ones, I put like it's losing like -5 or 10% per annum, flat, which is losing to inflation, so they have maybe some pricing that they can do flat price plus inflation, but that stays there. 5 to 10% growth, or 10 to 20% or more growth. Okay, so just to keep an idea of where this seems to be going. We don't know, of course. Then the next is this 30-year. The 30-year is more not for this specific business, but this line of business sometimes. And in very niche business, it's more this specific business, but it's here. Well, if I don't see it, like I just don't feel it. It's here that just Floor and Microsoft, at some point I did this, and then I said, well, I have no idea really. So I went back and said, yeah, too hard. And this happens for a few companies here also. But okay, it's low chance of being here in 30 years, no idea, which is not strong enough. Big chance, I think it will probably be here in 30 years. And yes, I'm pretty confident that this will exist in 30 years, okay? And in the last month, because it's been like a month since the last video and a month doing this, and then if an idea I like a lot, I will do like, well, I have my Word documents where I kind of store more my thinking. But then, yeah, as you saw in previous videos, I will do like a short presentation to show the idea to you if it's like an interesting thing. Okay, then here is back of the envelope valuation, like a rough estimate of what I think this is worth based on profits, direction of margins, and the maybe opportunity for the company. The current price, like this per share, and then the difference, right? In the last month, I've taken a look at 95 ideas, which 42% of them I said they are investable. Of course, I'm looking at very good investor portfolios at the moment, screening a bit, but it's been very like not many like that, but we would say yes. And then Value Investors Club picks, right? So they tend to be high quality ideas, like good investable. So the range has been like 42% yes, 30% don't like, 17%, 18% too hard, 9% too risky. And that's been the split at the moment. And I can show you maybe a bit the month. The last thing is the source, like where the idea came in, because if I find a good idea, I would like to do more of that, okay? But first I did this come from the Ticker, Ticker, the platform, the financial platform, the biggest like portfolios there. You can see them for free. And I took a look at the biggest positions there. Then Spark Life is something I was subscribed, but it's like it keep giving me like reports on that. It's like on the alternative market in the London Stock Exchange. I unsubscribed since, but mostly it's very tiny, not cheap, or not like it's not a pick by anyone. It's a random company there, which gives me a lot of companies to look at, but not particularly good. Okay, then I took a look at Hong, which is the TCI fund. Okay, let's see. Okay, and which is one of the biggest funds in the world and great returns, especially in the last years. And I just took a look at the positions. I did one by one all the ideas and see what sort of I liked. Okay, and then I did, well, this is the same. Okay, I did all the ideas there, and for a few of them, I said too risky. I don't like. Visa, I liked. General Electric, I liked. Ferrovial, I liked. These are two like railways, okay? And then Google, of course, I liked. Safran, which is aero, like they do aircraft engines, I also liked. But if you see, most of them, I thought they were a bit pricey, okay? Funnily enough, or maybe not, the most interesting idea I saw was AENA, which is a Spanish public company, but state-owned company, because I saw that it's investable, has super strong moats because no one can buy the airports that they are operating. The growth is being great. I'm for sure it's here in 30 years. And I think it's slightly relatively cheap. Like I have not bought, like first thing that, but then also I will never buy something that I don't think it's double of what I think it's worth. Like I like the price, the current price, I think it's worth double. If it's not there, I need some margin of safety. That's margin of safety here. Okay, let's take a look at AENA. I wanted to do quick videos. I will go a bit quicker at the moment, but AENA, it trades in the Madrid exchange, okay? And they operate all these airports in Spain. They have the, I don't know how you say that in English, but the government gave them the license to operate them, and they are the only ones operating, and it's quite state-owned still to this day, and they operate pretty much all Spain, so it's a huge bet on Spain air transport, okay? And then they also own some in London, okay? Like 18 airports in the United Kingdom, and then Brazil, and then some in US and, well, South America mostly. Okay, so it's, I said before we took a look at airlines, and I said airlines maybe not the right place to look, but airports probably a good place to be, right? And then we will, the problem with airports sometimes I think it's very regulated. So probably the profits you can get, the state just doesn't want you to become rich just because you operate their airports. Or if not, they would do it themselves. The idea, okay, they have the managing the airports, they have the commercial part of the airports, like the shops and selling stuff and the rent that they get that there. Some real estate services, which it's a tiny thing, okay, at this point. And then the international airports. If you see here between these two, which is the Spain mainly ones that they operate, and then there's the others. There's one part that is, I call it regulated, okay, regulated. So the state rarely will allow you to charge more per passenger per year, but if the passengers that you operate and you manage stay, they will also not force you to lower those costs per passenger, or just slightly, okay? But so this is pretty regulated. I don't think this margin is going anywhere, but I think passengers will grow down the, well, slowly, or not that slow, okay? The commercial part, if you see here, the margin here, you can see EBITDA here, it's capped at 50, but here we're at 83% margin EBITDA, which is bullshit earnings, but very good margin here. So this is the unregulated part. They can charge whatever they want to the shops in the airport. And there's a lot of business that need to be there, like the big brands, and it's just so many people in one place. That's why it's so expensive and lucrative in some ways. So I think this part should outgrow this part, but as passenger grows, this also grows, and they can keep charging more and more and more. Okay, that's the thesis here. The non-aeronautical per passenger will trend up, okay? So everything that is not the operating of the airports, and aeronautical per passenger will be flat, but the growth will come mainly from passengers, and I think in less than 5 years we should be around 400 million passengers, which were at 300, so that's a 30 something percent gain. And in 20, 30, 50 years it's more, like, you know, that it's more, like, we don't have to think too much about that. Well, think about this hard to know, but my conclusion is the same. This for the 9 months, because this was 2024, and this for the 9 months. And if we just see, the growth is still solid, and you can see the double here to here, and the margin stays where it is. They will just invest a bit more in the next year, but by the numbers, we're investing at 20%, 20 times earnings, okay? There's 5 billion in debt, let's call it 12 times EBITDA, but this is bullshit a bit, but let's call it maybe 20 something, 21, 22, okay? The revenue, as you can see, it's growing hugely, okay, hugely, and I think it will keep going. Of course, there's a pandemic here in the middle, but good return on equity, good return on employed capital, great business, okay? So what do we have? One, that it's impossible for anyone to compete here, other than another country getting more passengers there. But Spain, we all love Spain, and I'm a Spaniard, but you do too. Like, if you like to travel, you like Spain. Excellent underlying economics, the margins are ridiculous. Excellent future demand, ridiculous. Like, I think more people will come to Spain, and I think to our benefit mostly, but it will keep going. Like, I don't think the world is stopping traveling today, and people like it more and more, and everyone wants to see the world, and we get the opportunity to do it. Excellent state partnership so far. So far, they have allowed Aena to make their money, keep investing their money, and have, if they keep managing properly the airports, they are getting a good thing, okay? Same, the 50% regulated, 50% unregulated, so there's some part that they can keep pricing up, up, and I think it's slightly undervalued at the moment, in my opinion. Do your numbers, but I think it's slightly undervalued for the future that we can expect here. So, but I didn't invest, so I'm still looking, and I will kind of keep looking, okay? Okay, let's keep going up. Then I did a bit of Value Investors Club, which nothing to talk about too much, but if you see, I passed a few. Then I checked the portfolio of Gabriel Castro, which Gabriel is, well, it's a good investor from Spain. I got packs from him. Baba, you could say I got from him, but, well, I knew about Alibaba. It's just that, well, it's people that you check their portfolio, the company is still there, you check it again and again and again, okay? Of course, Nagacorp, I also got from them. I still love Nagacorp, so I will say, we'll see how the recovery goes, but so far I still like it. Okay, by proximity, when I say this, it's because him invested in Ploxy, which is like employee benefits, like those credit cards that you get, and they go without taxes by your employer. And this is like the number one company, this is the number two company. In the end, I didn't like them a lot, okay? So good portfolio. Most of things I just couldn't buy, okay? Then we keep going up. I did a bit of Value Investors Clubs. I started screening a bit, but if you see screening, I passed on all of them. Then this one I liked a lot. This Top of Europe is like a ski resort. You can go there by like kind of rail. You pay a big price, but it's so pretty. It's on top of the mountains in Switzerland, and there's nothing like that in the world. Okay, so huge mode, but I don't think it's cheap at the moment. But future-proof, great. It's like a toll, like on the highway. Then keep going up. Japanese pharmaceutical wholesaler, but that's from Value Investors Club. It's just that the mod doesn't seem that strong, and then trajectory is pretty much inflation or lower. Okay, then I screened a bit. That one that looks kind of cheap. It's they do like dairy tin cans also in Malaysia. Some growth, probably here for a while, probably cheap, but what do I know about Malaysia? Exactly, nothing. Okay, then a bit more of checking people's portfolios, big and global, bit of screening, nothing came. Lone Pine, same thing, I checked their portfolio. I wanted to look at ACML. It's not the first time we look at it, but I just wanted to see if it was cheap at all, because the SMC was rather cheap some months ago. So no, it's super expensive, I feel like. Then we kept going up. I took a look at this small bank in Mexico, okay, and it comes from this idea, but well, we can skip a bit, but it's just that it's one of the small banks in Mexico where they are BBVA, as we call it, BBVA. It's an oligopoly, but the smaller banks are taking market share because BBVA it's like pricing here like the cost of money, and they can underprice them a bit because, well, they don't need to make, well, not BBVA has to make that much money, but they have a kind of a tightrope on the market and they can undercut them. Is it cheap? The thing is, I don't think it's that it has that big of a moat. Probably it doesn't have a big moat. Okay, let's keep going up, and then we have Birna, which was a fun idea. Well, fun idea. I liked it for a while, and then I said, nah, no, I don't love it too much. Birna is non-lethal weapons, or less than lethal, as they call them. So it's like pepper gas guns, and then some like kinetic bullets, and yeah, self-defense thing. So legal in all states. It has a good range, like guns. So I think US has a big problem with guns, and maybe this might be a solution. But then the more I thought about it, maybe not. Maybe if everyone gets like only these guns and they ban any other guns, sure. But like if you pull this gun and someone has a real gun, and he was not even trying to tag you, and you just went crazy, and I don't think that's rare there. Yeah, I think they will come after you thinking that you are firing real weapons to them. Okay, and also like I liked kind of the economics because it's growing a lot like crazy, and yeah, you're paying quite a bit, but it got good margins. I like the idea behind it, but nothing else. But if you see the growth, it's crazy, and they are profitable still. Okay, and you're paying like 270 million for them. But I said, the more I thought about it, nah. Okay, then two ideas that they kind of go together, and they are from Value Investors. The Pool Corp came up, but then I also have from Cas Partners. What's his name? Well, I'm blanking on his name, but an investor we got Carvana from originally, and its Pool Corp is like the biggest distributor of pool products like in the world. Like if you see, they have pretty much everywhere in the world, and they are huge. They have good economics. Like you can see here, the kind of the economics also. Like look at the margins for a distributor. Okay, like that's good margins, like really. Okay, but some are entering the market, and also I don't know, they have a huge representation in the US. Like a lot of their profits come from US. They are spread around the world, but mostly US. And I don't like the demographics in the US so much. I don't think we're seeing way more pools. Same as construction data, that I don't think we'll see way more homes, even if there's a shortage, because they are mature economies at this point and not growing as much. And I don't think we'll see a lot of pools. But if you see, both are relatively cheap, even I value pretty conservatively. I will say that I always do that. And Latham, if you see here, from Cast Partners. I don't know that, I don't remember the name of the guy, but they do in-ground, like they do fiberglass pools, okay, in-ground covers and liners, and they are the number one player. They have manufacturing in the US, they have good economics, and if you see like their idea at the moment, they have 62,000 pool starts. If they got to 78,000, which is below like 2019, like, well, 2019 before pandemic huge boom, and then it fell through. But I'm not as sure as if we go back to this like 2019 number. And then also, like they say, like they will do EBITDA, this adjusted EBITDA, 160 million. Okay, and look, that's from corporate. That's what they we're trading at 1 billion. Okay, and I don't think we're going back there. But if we were, like, that's not bad. Like that's 7-8 times, but for a cyclical business, looks like. And I don't love the demographics, sure, but yes, we come from a big peak, so it's an idea that I kept thinking about. It's not the first time I look at Latham, but my thinking behind is I don't know if we'll see that huge construction boom again, or that huge, and a lot of sales of pools are when things get constructed. They're remakes and sure, but I was thinking about it, and if I got a good read on the market and I saw like maybe like there might be a good boom for pools and construction in the US, I might pull the trigger here. But so far, no. And that's pretty much it. At the moment, I'm still sitting on this money, not sure what to do with it. I will keep looking at ideas. It's not that bad that we have 10% liquidity, but I would say it's more like 17% liquidity, because these two ideas, I think they're up to a change. So I'm just looking where to put 24,000 euros soon. And maybe in the portfolio, there's things that I could buy, maybe not. Okay, but that's all for me today. Okay, thank you for watching. If you like this and want to stay tuned, just subscribe. I will probably make this public, so you can go here there's a link in the description to see the portfolio, and then if you click here, you can see my live kind of research. Probably that part public, maybe the exact positions no, but so you can take a look with me what I'm looking at. Okay, thank you. Be safe. See you in the next one.